Today we're doing a complete breakdown of Indian Accounting Standard 12. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a scenario where deferred tax liabilities were consistently underestimated, leading to a sudden $10 million surprise hit to a company's financials. Indian Accounting Standard 12 was introduced to prevent such shocks by ensuring tax obligations are properly accounted for. By the end of this section, you'll grasp how this standard safeguards financial transparency and accuracy. Before Indian Accounting Standard 12, companies faced significant discrepancies between financial statements and tax returns. Deferred taxes were often underreported, causing financial instability. This standard was designed to align the reporting of current and future tax obligations, ensuring that investors and stakeholders have a true picture of a company's fiscal responsibilities. This alignment enhances transparency and comparability across financial reports. All entities preparing financial statements under Indian Accounting Standard must adhere to Indian Accounting Standard 12, which took effect from April 1, 2016. Its primary requirement is the recognition of deferred tax liabilities and assets, reflecting future tax consequences of current transactions. This standard mandates reconciliation between accounting profits and taxable profits, ensuring that financial statements accurately represent a company's tax position and obligations, enhancing investor confidence. The tax effect accounting model in Indian Accounting Standard 12 is pivotal for understanding deferred tax. It provides a framework where future tax consequences of transactions are anticipated, aligning book and tax values. This model is crucial in interviews, as it demonstrates your grasp over projecting and understanding future tax impacts on financial statements, a skill highly valued in financial analysis and planning. Knowing this can set you apart in job discussions. Understanding the scope of Indian Accounting Standard 12 is crucial. Many candidates make the mistake of including taxes not based on income, which is a classic interview trap. Knowing precisely what is covered and what is not can set you apart. Let's unpack these nuances and get clear on what Indian Accounting Standard 12 really covers. Indian Accounting Standard 12 specifically addresses income taxes, including those payable or receivable at year-end. It incorporates deferred tax assets, which arise from deductible temporary differences, and deferred tax liabilities that stem from taxable temporary differences. Understanding these inclusions is vital for accurate financial reporting and compliance. These elements influence how future tax benefits and obligations are accounted for in financial statements. Interview traps often revolve around exclusions like taxes not based on income, which Indian Accounting Standard 12 does not cover. Another tricky area is deferred tax arising from the initial recognition of an asset or liability outside business combinations. These exclusions are key to avoid misapplication of the standard. Recognizing transactions that do not affect accounting or taxable profit is crucial for accurate application. A deferred tax asset represents future tax savings due to deductible temporary differences. For example, if a company incurs a loss, this can offset future taxable income, leading to a deferred tax asset. Recognition hinges on the expectation of future profits to utilize these deductions. This concept is vital for predicting a company's long-term tax position, impacting its financial health and performance outlook. Deferred tax liabilities arise from taxable temporary differences, indicating future tax obligations. For instance, if a company uses accelerated depreciation for tax, it reports lower taxable income now, creating a liability for the future. This liability reflects an expected increase in taxable income, necessitating careful planning to manage future payments. Accurately estimating these liabilities is crucial for strategic cash flow management and financial planning. Navigating scope edge cases can be tricky. Foreign tax credits are outside Indian Accounting Standard 12's coverage since they're not income-based. Initial recognition rules ignore right-of-use assets unless in business combinations. VAT and GST are also excluded as they're non-income taxes. Dividend taxes can be included, but only if tied to business combinations. Understanding these nuances is essential for applying the standard correctly and avoiding costly errors. Timing differences between tax reporting and financial accounting can skew perceived profitability. The tax effect accounting model aligns these, ensuring companies like Meridian Corporation accurately reflect tax liabilities and assets. Picture a $10 million SaaS contract. Understanding its tax implications is crucial for both compliance and strategic decisions. The tax effect accounting model ensures financial statements reflect true tax obligations. For Meridian Corporation's $10 million SaaS contract, $8 million software, and $2 million in services, each step will reveal the tax implications. This model reveals timing differences, calculates deferred taxes, and ensures accurate tax reporting, crucial for financial transparency. Meridian Corporation's $10 million SaaS contract kicks off by identifying temporary differences. The $8 million software component might have a different tax base than its book value, creating a temporary difference. A common pitfall is missing these discrepancies, especially in asset valuations. Indian accounting standard mandates recognizing all such differences, setting the stage for subsequent tax calculations. With Meridian Corporation Software's $2 million temporary difference established, the next move is applying the correct tax rate. Missing the mark on jurisdiction-specific rates can lead to under- or overestimating tax obligations. Indian accounting standard insists on using current or substantively enacted rates, setting a clear path for tax calculation. Assume a 30% tax rate, leading to a $600,000 potential tax impact. Moving forward, Meridian Corporation calculates the deferred tax. With a $2 million temporary difference and a 30% tax rate, a $600,000 deferred tax liability emerges. A frequent misstep is treating deferred tax as current tax, skewing financials. Indian accounting standard dictates this deferred tax aligns with the timing of identified differences, ensuring financial accuracy. Recognition in financials is the next leap for Meridian Corporation. The $600,000 deferred tax liability now finds its place on the balance sheet. It's critical to avoid the oversight of not updating financial statements with these adjustments. Indian accounting standard mandates that deferred taxes be clearly represented, painting a transparent financial picture. The final frontier for Meridian Corporation is assessing valuation allowances on the $600,000 deferred tax liability. This step ensures that the liability aligns with future profitability expectations. A common pitfall is misjudging the realization of tax benefits. Indian accounting standard emphasizes using sound judgment, not just numbers, to decide on these allowances, ensuring the financials reflect true potential. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Proper measurement affects tax liabilities and can change the financial landscape of a company. Understanding disclosure requirements ensures stakeholders see a complete and transparent picture of your financial health. These decisions aren't just numbers, they're strategic moves. When it comes to deferred tax, recognizing assets and liabilities hinges on temporary differences. These differences occur between the tax base and carrying amount of assets or liabilities. It must be probable that future taxable income will arise to utilize these assets. The measurement uses tax rates expected at the time of realization or settlement. This sets the stage for accurate balance sheet presentation and aligns with future economic expectations. Subsequent measurement of deferred tax is a dynamic process. Regular reviews ensure the deferred tax assets remain probable for realization. Adjustments are made for changes in tax rates or laws. If future profitability outlooks shift, this can also impact deferred tax assets. These ongoing evaluations help maintain the accuracy of financial statements. Without them, companies could face significant discrepancies in their reported financial health. Deferred tax assets and liabilities find their place in non-current sections of the balance sheet. Offsetting is permitted when specific criteria are satisfied. Notes must disclose the nature of temporary differences, including unused tax losses. Proper classification ensures these tax items align with their corresponding assets or liabilities. Accurate presentation helps users interpret the financial impact of deferred tax and its future potential. Disclosures illuminate the often obscure world of deferred tax. A reconciliation between effective and statutory tax rates sheds light on tax strategy. Revealing unused tax loss expiry dates offers clues about future tax positions. Details on temporary differences help analysts predict potential tax impacts. Adjustments related to changes in tax laws offer transparency into management's strategic decisions. These disclosures are vital for thorough financial analysis and stakeholder confidence. Consider a CFO managing a $500,000 deferred tax asset from tax loss carryforwards. Given expected profits, they determine 80% will be realizable in 5 years. With a recent tax rate change, the asset's value increases by $50,000. Disclosures outline the expected timeline for realization and the reasons behind remeasurement, providing clarity to stakeholders. This scenario demonstrates the precision needed in managing tax assets and strategic planning. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Dive into the nitty-gritty of recognition, measurement, and reporting as we unravel the financial implications of this lease. Upon signing the lease, Meridian Corporation records a right-of-use asset and a corresponding lease liability of $500,000. This aligns with Indian Accounting Standard 116's requirement to bring lease obligations onto the balance sheet, enhancing transparency. This entry means the company now reflects future lease payments as liabilities, directly impacting its financial position. A monthly lease payment reduces the lease liability by $10,000, consistent with the amortization schedule. Indian Accounting Standard 116 mandates the reduction of liability upon payment, impacting cash flow and debt levels. Meridian Corporation's bank account reflects this cash outflow, showing the real cash commitment of the lease. The right-of-use asset is depreciated monthly over the lease term, here $8,333 per month. This reflects the asset's consumption over time. Aligning with Indian Accounting Standard 16, it impacts earnings by increasing expenses, providing a more accurate picture of asset utilization in financial reports. Interest on the lease liability is calculated using the implicit rate, adding $2,000 to expense accounts. Indian Accounting Standard 116 requires this interest accrual to reflect the cost of financing the lease, affecting net income. Meridian Corporation's statements now show the true cost of its leasing arrangement. Adjusting lease liability at year-end ensures all payments and expenses are accurately reflected. This $120,000 adjustment aligns with Indian Accounting Standard requirements for precise liability reporting, impacting equity, and providing stakeholders an accurate financial snapshot. It's crucial for transparency in Meridian Corporation's financial health evaluation. With CPI changes, Meridian Corporation remeasures its lease liability, increasing it by $15,000. Indian Accounting Standard mandates such adjustments to reflect economic conditions accurately. This impacts both the balance sheet and future expense recognition, ensuring the lease cost remains relevant and precise. Upon lease termination, Meridian Corporation de-recognizes the remaining right-of-use asset and liability. Indian Accounting Standard 116 requires this to reflect the cessation of economic benefits and obligations. This entry clears these items from the balance sheet, finalizing the financial impact of the lease agreement. Every Big Four and investment bank interview on Indian Accounting Standard 12 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Indian Accounting Standard 12 deals with accounting for income taxes. It ensures that a company's financial statements reflect the current and future tax impacts of transactions. The standard addresses both current tax, pertaining to taxes payable or recoverable for the current period, and deferred tax, arising from temporary differences. A common mistake is overlooking deferred tax liabilities in long-term asset deals. Remember, deferred tax smooths tax expense over time. Deferred tax assets arise from deductible temporary differences, tax losses, or tax credits. They reduce future tax payments, reflecting expected tax benefits. For example, a company with carry-forward losses records them as deferred tax assets, anticipating future profitability to use these losses. A typical error is confusing these with current tax assets. Key point: they represent future tax savings. The core principles of deferred tax are similar under Indian accounting standard and international financial reporting standards, but differences arise in specific applications. For instance, under Indian accounting standard, revaluation gains are recognized differently, affecting deferred tax calculations. A common trap: not analyzing initial recognition exemptions properly. Remember, aligning tax bases and accounting bases is key to understanding differences. When PPE is revalued, it creates a temporary difference, leading to deferred tax. Indian Accounting Standard 12 mandates recognizing deferred tax liability on the revaluation surplus. For example, a surplus of 100,000 rupees at a tax rate of 30% leads to a 30,000 rupee liability. Avoid forgetting deferred tax on non-depreciable revalued assets. Always consider future tax implications. To calculate deferred tax liability, multiply the temporary difference by the tax rate. Here, 500,000 rupees multiplied by 25% equals a 125,000 rupee liability. This amount reflects future tax obligations due to temporary differences, like accelerated depreciation. A common mistake is using the wrong tax rate for calculation. Ensure you use the correct rate for precision. Disclosures under Indian Accounting Standard 12 include components of tax expense, explanations of temporary differences, and tax rates applied. Also required are reconciliations of effective and statutory tax rates and any adjustments from prior periods. A common pitfall is missing disclosures for unrecognized deferred tax assets. Ensure clarity and completeness in disclosures to meet compliance. Goodwill, as per Indian Accounting Standard 12, is generally excluded from deferred tax calculations due to non-deductibility for tax purposes. Temporary differences relating to goodwill from business combinations, however, can lead to tax implications. Trap: assuming all goodwill is exempt from tax considerations. Key takeaway: assess each business combination's specifics for tax impacts. A company assesses deferred tax assets' realizability by evaluating future taxable profits. Indian Accounting Standard 12 requires that these assets are recognized only if future taxable income is probable. Avoid the trap of neglecting to review forecast accuracy. Regularly update projections to ensure deferred tax assets reflect realistic future tax savings. Key: use judgment backed by data. Unrecognized tax losses are not included in deferred tax calculations until they become realizable. Indian Accounting Standard 12 states that only probable future tax benefits should be recognized. A common error is prematurely recognizing tax losses. Always assess the likelihood of future taxable income before including losses in deferred tax assets. Key: prudence is crucial. Indian Accounting Standard 12 is all about recognizing the tax impact on transactions. It applies to taxes based on taxable profits. Understand current tax as the amount due for the current period, while deferred tax arises from temporary differences. Key definitions include tax base, which is the amount attributed to an asset or liability for tax purposes, and taxable profit, the net income subject to tax. These basics set the foundation for mastering the standard. The tax effect model ensures that both current and future tax implications are reflected in financial statements. Deferred tax assets and liabilities are measured using tax rates expected at reversal. Recognize tax impacts on the income statement, adjusting for items in other comprehensive income. Temporary differences are key for deferred tax, aligning book and tax values over time. Deferred tax assets require reliable estimates of future taxable profits. Regularly reassess balances as assumptions evolve. In interviews, highlight common pitfalls like book tax depreciation misalignment causing deferred tax errors. Stress the need for assurance of future taxable profits when recognizing deferred tax assets. Understand Indian accounting standard differences, focusing on timing versus permanent differences. Key disclosures include reconciling reported and effective tax rates, and only offsetting under specific conditions. Also, revaluation impacts and immediate adjustments for tax rate changes are crucial knowledge areas. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.